We now move on to the insurance-specific issues dealing with risk, hazards, and finance. We are very grateful to Alex D. Sherbinin and Charlie Huyck for putting together a very esteemed panel to discuss, are we in good hands navigating the future of high-risk property insurance? Alex?
Thanks, John. So greetings, everyone. My name is Alex Sherbinin, and I'm the Deputy Director of a Spatial Data and Research Center called Season here at the Climate School. In this panel, we're going to be discussing a topic that will be of interest to, I dare say, nearly everyone in the room, which is the question of homeowners insurance. Without it, we are at risk of potentially catastrophic financial losses in the event of a disaster. And if we seek to sell our home, new buyers are required to obtain insurance in order to get a mortgage. Yet many insurers are pulling out of certain markets, and the cost of insurance policies has been rising steeply. If you've looked at your bills recently, you've probably noticed that. The confluence of growing climate risks and weakened insurance markets could lead to trillions of dollars in stranded assets. Benjamin Keyes, a professor of real estate at the Wharton School of Business, in a recent New York Times op-ed, which is entitled, "Your Homeowner's Insurance Bill is the Canary in the Climate Coal Mine," writes the following: "If you don't think that you've been affected by global warming, take a closer look at your last homeowner's insurance bill. The average cost of coverage has reached $1,900 a year nationwide, but it's $4,000 a year in New Orleans and $5,000 a year in Miami." Today, we'll explore the ways in which insurance is in fact a market and how insurers are struggling to make a profit as climate disasters mount. We'll discuss how insurance can send signals that help steer development out of high-risk areas and promote adaptation. And we'll talk about the promise of new insurance approaches such as parametric insurance and InsurTech, among others. We're delighted to have with us today a panel of distinguished experts on this subject. Charlie Huyck is the Executive Vice President at ImageCat, a cat modeling company with headquarters in California. He's based in North Carolina. Jay Mullen is an insurance sales manager at Esri with deep experience in the insurance industry. And Megan Hart is a managing director of Aon. Unfortunately, Tobias Grimm of Munich Re was unable to join us at the last minute, so we'll have the three panelists. Then what I propose is I'll propose to ask a few questions, and then I'd really like to open up the discussion. So be taking notes and think about what you'd like to ask the panelists as they go through their presentations. With that, I invite Charlie up to give his presentation.
All right, thanks, Alex. Yeah, as Alex said, I'm Charlie Huyck, Executive Vice President, one of the founders of a company called ImageCat. I do a lot of the things that David Qatar was talking about in the last presentation. We do kind of boutique modeling on a smaller scale. We do a lot more work for governments and take a look at policy, and that enables us to look at interesting problems. And as part of that, I've done a lot of work for NIBS over the years, worked with Bob Chen, Alex Sherbinin, and quite a few of you here in this room. And, chatting with Alex and Bob, we started to just really realize that there's this sort of problem out here that might not be on the minds of the geography community and the climate community that we should try to kind of nail home, because it's going to be pretty important. So one of the things that I started doing a lot in my career early on with the National Institute of Building Sciences is looking at the cost effectiveness of building, mitigation, building to code, building above code, and these types of things. With all the bumps and warts that Eric was talking about, all the limitations, still, to even make the case that something is cost effective to do is a big accomplishment. So some research that I was personally involved with was this report up in the upper left, Natural Hazard Mitigation Saves. We analyzed the cost effectiveness of building above code and computed a benefit cost analysis, and surprise, surprise, it was very high, right? I think in Florida, it's like 5 to 10. That means for every $1 you spend on building your house, you get $5 back, theoretically. So this guy did this. According to Jay, he actually went quite a bit above board, but And this photo is widely heralded as a massive success story by New York Times and others. So, quick show of hands. Who wants to own this property? Right? You know, you're not going to go. You're not going to want to go to the beach there. You're not going to be able to sell it for as much as it's worth. You're not going to be able to rent it out for others to go to the beach there. And in the commercial real estate market, we call this stranded asset, right? Because if you do the right thing and your property survives, but the economy doesn't, you're not going to be able to monetize that asset, and it's the same as if you have a home. So the question is, how come everybody else there didn't build above code, right? And there's a million reasons why they didn't do that, right? It's probably not cost effective for them if they only plan to own the property for 5 to 10 years, or if they're looking at the end of their life, or because, that value is not going to necessarily accrue to the next person that they sell it to, and the likelihood of getting, if they were to do the math, it wouldn't necessarily be cost effective for them to do that mitigation. And maybe they don't want to be the only one left on the block, right, after an event happens. So what ends up happening is we depend on insurance to come in on their white horse and save the day, right? But guess what? Insurers know better than anyone how the impact of climate change is manifesting on the ground, right? And they're either going to charge what the risk, bears, or they're going to get out. They're going to get out, and that's going to leave a huge gap with all sorts of cascading failures, implications for mortgage and everything else. So our institutions are not keeping up with the evolution of risk. Insurance is the way that society manages risk, and it's not keeping up because of our government institutions and all sorts of things. Now, this is all very negative, and there are some people doing some great things. I was very surprised to see Lars Powell in the back. You want to stand up, Lars? Take a bow. Working at University of Alabama, coming up with some very good solutions about how we can sort of share or mandate or work with IBHS to make sure that people do the right thing. But this photo is not alone. There's photos like this for every hazard, right? The anomalous person who does the right thing, their property survives, but we're not doing the right thing as a culture. And maybe the right thing is to get out of town, right? Maybe it's a managed retreat that we have to do eventually. So anyway, the point that I'm trying to do to set the stage here is just make the point that insurance is where the rubber meets the road for climate change and impacts. And it's going to be our first battlefield in trying to figure out, how adaptation should be implemented. And oh, by the way, everything that Eric said, right? On top of that, we have to think about equity when we consider that process. So, thank you.
Thanks, John.
Great job. Take this dude here. All right, hey everybody. So I'm Jay Mullen. As he said, I'm the sales manager at Esri. And I'm not a geographer, I'm not even a GIS guy by trade. Let's see if I can get my slides up. So introduction, my team and I support the global business of insurance and implementing systems, right? I was gonna come up and talk a little bit about climate change. I think we all agree, we're on the same page, that our world is at risk, and that, put it very well, the rubber meets the road in the business of measuring and exchanging risk for money and assessing that. And, I come from a different experience. I come from the military. I spent 10 years in the desert in different conflicts, trying to slay the dragons that we saw, fighting our nation. And after about 10 years of that, I realized that there was other places where I could fulfill that selfish need to slay dragons, and it was in catastrophe response. On an expedition in the Southeast Asia, I was deployed to a natural disaster where thousands perished, and I saw the impact of those disasters and how people responding and resilience, like was discussed here, could make a better outcome for those situations. And so I pursued a career as a catastrophe adjuster. Meanwhile, staying in the reserves and having since been deployed on both sides to where the rubber and the road meet and seeing the effects of the catastrophe, both showing up to evacuate old folks from a flooded assisted living facility or evacuating them after they had perished in their beds and taking them to the morgue because the floodwaters in Harvey were too high to get ambulances out there. And then on the insurance side, to showing up and providing them the indemnity that they needed to get their lives back on track. So that's the experience that I bring to the table. And when I went to an insurance company, I was able to implement remote sensing, Earth observed data strategies using drones, aerial imagery. We use planes. We use the Geospatial Insurance Consortium data. We had a team of drone pilots. We used satellite imagery. We used our phones, everything that we could possibly get. And we built systems to bring all that stuff together and really, at the end of the day, get to a triaged list. Who's been affected, to what degree, and what do we need to do about it now? Geography is at the center of all that. And I naturally was drawn to the geographic information systems in place and how we could gather the data, visualize and analyze this information programmatically to get down to decision-making information, right? At the end of the day, a triaged list of the claims. And that same process, like we've heard a couple other speakers talk about, can apply to the business of underwriting too, right? Just because we're looking at the change or the damage in properties in the claim space, those same underlying processes, the same cycle applies to risk assessment. And better risk assessment will, better pricing, the whole cycle will be better and increase resilience, right? It's all about creating the understanding and sharing that information, right? On the underwriting side and on the claim side, as well as in risk mitigation. And I think a lot of our insurance, and I have experience, we all have experience with an insurance policy of some sort. The Verisk gentleman yesterday spoke about those three things, right? Assessing risk, mitigating risk, and then indemnifying right after the claim happens. A lot of carriers may do one of those. They may pay the claims very well, right? But are they doing anything for you in your experience? Are they doing anything to help you mitigate? Are they doing anything to help you understand what needs to be mitigated and how to put those loss control efforts in place? Some insurers are, don't get me wrong. This is happening in some places. So if you have good experience with your insurer giving you that information and helping you, that's great. And on the underwriting side, how many of them are insuring with the right information? How many of them have the systems and the data in place to make those decisions, right? Geography being at the center of all of that, right? That's why these systems are so important. And that's what I see as our role in assisting these folks from risk pricing to risk assessment, investment in their property. You know, insurers also have a large commercial real estate investment. You know, it's just like your 401k plan, your financial advisor. They all follow a pretty similar investment strategy. And you'd be surprised to find out how much commercial real estate out there is owned by the different insurers' investment groups. So investment in commercial real estate could be a big contributor to curbing climate change in applying the same methods to risk assessment that insurers need to do in the future. Applying that to their investment strategy could be very impactful, because then that would guide where new, developments start to occur, where, new large commercial organizations start to build new resilient structures. And then collaboration, right? Insurers need to collaborate more, and I realize this in the claim space more than anything, with the governmental organizations. One example was we collaborated with the LA County in the fires in Malibu, sharing imagery back and forth, right? Having a common system to provide their insights, or provide our insights to them and share their insights back with us. It created a faster cycle of recovery. All of those things revolved around a geographic information system. Some examples of things that we work on, basic things on the top right, I call high-resolution risk assessment, underwriting applications for people to interact with and zoom in. A lot of this is done programmatically. So in the middle, a lot of times the underwriters are just doing reviews, and where change is occurring in their data, they're able to pull up and zoom into the specific property and understand what's changed, what data provider's new data element has come into their system, or what new inferencing or what new element needs to be evaluated. Climate change reporting, I think, applies across the board in pricing, in mitigation, and in their investment portfolio, like I said, and we support systems that deal with the global raster data sets for them to programmatically get access to that in a scalable way, quickly understanding what the future is going to be like at those individual properties. And we do this in partnership with, for one, Verisk. Their data looks out 2030, 2050. What's the sea level rise going to be at this location at that point? What's the temperature? What's the days without rain, et cetera? And then down on the bottom left, the really exciting one is the digital twin building, right? Supporting systems that allow for these digital assets to be visualized and analyzed with 3D mesh and context of other information overlaid. Flood analysis is pretty bread and butter, but it's advancing rapidly. Insurers need to understand what tools are out there and what data sources they have access to. And then really the soapbox that I'm always on with my customers is just the ABCs of it all, right? Always be curating. You need to label if you intend to be in business in the future. You need to click on things. It's basic. You need to click on things that you want to create automation for in the future. And that's the workflow diagram in the middle is just an example of how we set up these systems to allow them to click on those things and create the machine learning training data sets that they'll need to create their own inferencing capabilities. So thank you all. I'm very excited to be here. This is a great panel of experts, and I'm honored to have joined them. But I think we all agree the underpinnings of insurance are very tied to geography. So great topic. Thank you.
Good morning. Firstly, I just want to thank you all for having me, and Alex and Charlie for having me on this panel. This is my first time at an AGS event, and I have been blown away by the depth and breadth of information that I've heard from all the presentations over the last day and through all these conversations, and I really look forward to being part of this community and continuing those conversations. So my name is Megan Hart, and I'm the Global Head of Analytics and Collaborations for the Climate Risk Advisory Team at Aon. And for those of you that aren't familiar with Aon, I'll give kind of a brief introduction. We are a company of 50,000 plus in 120 countries globally, and we focus on helping our clients make better decisions. And what I mean by that is better decisions about managing their risk, better decisions about managing their health and benefits with their employee base, their talent, and their wealth and investments. And I'm really going to focus on that first item, that better decisions around risk. And we do that in primarily two ways. One way that we do that is as a primary insurance broker. So in that capacity, we act as an advisor to corporates, financial institutions, the public sector on how to manage their risk and transfer that risk into the insurance industry, and that includes property risk. We also do it as a reinsurance broker. So in that capacity, our clients are insurance companies, and they are also managing their risk from natural catastrophes, which we've been talking about a lot over the last 24 hours. So managing that risk by transferring that potentially into the reinsurance industry. And really, both of those decisions are underpinned by data and analytics. And the decisions are, do you retain the risk? Are you comfortable with it? Do you avoid the risk because you're not comfortable with it and maybe you aren't able to price for it? Do you reduce your risk through helping with mitigation or identifying areas where you can be profitable? Or do you transfer the risk? And really, you need data and analytics to determine the right holistic risk strategy to determine how to be a profitable company and really invest in that risk management strategy. So really, with where Aon sits, we really understand and we're in tune with the insurance industry. And as we've noted here, the insurance industry is extremely important, but we're really in a state of evolution right now with what we've been observing. So I want to talk about that for just a few minutes in terms of what the insurance companies have been seeing and how that's impacting how we as an industry should be moving forward. So here in the first slide, I have some losses. So I'm stating the obvious here with this first slide. losses are increasing. So here we're looking at global insured losses by peril aggregated from 1970 to 2022. And that top curve, it might be a little bit challenging to see the colors, is global tropical cyclone. Probably not a huge surprise to the people in this room that that's really driving the overall losses. And we see big jumps in that curve in years where you have significant events. You started with Hurricane Andrew, and you see that first jump. Then you see Katrina happening. Then you see Sandy, and then more recently, Irma and Ian. And so we're seeing those big jumps in those particular events in terms of their severity. The curve that's really just right underneath that might be a little bit more surprising, and that's because we're looking at severe convective storms. It's a much more smooth curve because as a peril, that's higher in frequency, but also increasing in higher severity. And so the insurance industry is really, in some cases, being caught off guard by the losses that are occurring and starting to drive really the insurance and reinsurance industry global for that particular peril. Underneath that, we have flood, and we've talked about that significantly over the last 24 hours and some of the challenges there. The only reason why that's so much lower than tropical cyclone and severe convective storm is because we're looking at insured losses. And we've noted this morning in the presentation by the flood-based founder that there is a huge protection gap when it comes to flood. So if we were to be looking at economic losses instead of insured losses, you'd see that jump up. The last peril I want to draw your attention to is the one at the bottom, and that's wildfire in red. And those losses were low, and they stayed low until we hit 2016. And then we see a very distinct change in what the losses looked like for that peril. That's when we started to see more severe events causing more damage into the insurance industry, and that's really driving a lot of what we're seeing happen in California here. Now, can I say to all of you, this is climate change, this is all climate change? And the answer is no. Now, are we seeing a change in frequency and severity of losses from natural catastrophes? Yes. But is it just climate change? We know that attribution is very challenging, so we also need to be paying attention to all the different sort of knobs that are being turned that are leading to the state of the market today. And that's not just these increases in events as they stand. A lot of what's driving this is exposure. So where are people building and where are they landing themselves? And we continue as a society to move into very high-risk areas. So we're seeing a lot of people still move into coastal areas impacted by tropical cyclones. We're seeing people move into the wildland-urban interface and the intermix, very high risk for wildfire. We're seeing major metropolitan areas in the central U.S. that are increasing our footprints there and leading to larger losses for severe convective storms. So in general, we've got more people in harm's way. We're also seeing the increases in replacement costs. So, in general, we're seeing, the increases in building cost of goods and services for replacing. We're seeing issues with inflation. We're seeing challenges with claims and fraud that are also leading to these inflated losses. But overall, the result as an insurance company is we're seeing increasingly expensive weather and climate-related natural catastrophe losses. And if they are a business that is to remain profitable, they need to be considering sort of the changes in the trends and recognize that traditionally, as they've used their historical data to predict the future, that's no longer going to be the solution. In addition, there's a focus on different types of perils that have really been largely ignored by the industry up until now. So there's more of these chronic perils that are going to have influences on things like property values, supply chain risk, where businesses are landing, population migrations, and those are going to impact the insurance industries as well. So they need to be focusing on a more future-focused view of risk that takes into account projected changes that could impact the way that they operate. So here we're looking at a couple of key perils under the middle-of-the-road SSP, shared socioeconomic pathway scenario. with using Aon's Climate Risk Monitor. I figured I had to have at least a couple of maps in this presentation, right? So this is under the year 2050. So on the left there, we're seeing changes in extreme heat as defined by days per year over 35 degrees Celsius. And an extreme heat has huge impacts on human health and life. Again, as I mentioned, can lead to supply chain disruptions, increased operating costs, employee productivity, and really can have a huge impact on where people are migrating to. And we see the biggest increases occurring in the southern US. On the right-hand side, we have drought, and we see large increases in coastal Pacific Northwest and in Southern California. And that also has extreme economic impacts on agriculture and other sort of things that you need to live in a certain area, water shortages, for example. And then we've got the cascading effects of these types of perils. So drought, extreme heat, extreme precipitation, wildfire risk, they are all tied together. And we can't be thinking about these types of perils in isolation anymore. We need to be thinking about them more holistically. So is it all bad news? I am an optimist, so I'm going to end these presentations being optimistic in that I am seeing the insurance industry asking the right questions and investing in the right technology. So we work very closely with the team at Verisk and RMS Moody's and a number of new insurtech startups to understand how risk is changing and come up with future-proof strategies that allow us to continue as an industry to support community resilience in the face of the changing risk. And two sort of themes that I pulled out here was evolution. And there needs to be some broad evolution in terms of creating a better environment for insurance carriers to operate. And I think we'll talk a little bit about that on the panel in terms of allowing insurance companies to charge actuarially sound rates and working with regulators on good solutions for supporting these communities. Improve mitigation and resiliency programs to reduce loss. So, focusing on where we need to leverage grant programs to invest in some of our most vulnerable communities. Embracing academic research to advance understanding and risk. We've got a couple of Aon's partners here that have been working on helping us understand tropical cyclone risk in a future environment. And we are able to use that information to help our insurance company clients to understand what they could be expecting and how they should be reacting to sort of the research in real time. In addition to that, innovation, really important. Flood-based, again, I'll call them out for bringing new risk transfer mechanisms to the market. So we've got things like parametric solutions where you're not relying on claims adjusters to determine what the losses are after an event, and then you go through that process and there's potential for fraud and then you see claims inflation. So new risk transfer mechanisms, allowing for a more future-focused view of risk and really leveraging all the work we're doing to project forward rather than relying on history. And then, really incorporating new understanding of cascading and compounding risks is going to be really key. It's no longer the case that every peril and region should be considered independently. It's also the case that every single line of business within the insurance industry should be considered independently. We need to be considering liability risk, casualty risk, property risk, and so on and so forth, life and health even, under this umbrella because we now know that they are so interconnected, and also just, doing a better job of communicating uncertainty when we are, using this information to make better decisions.
Great.
Really good. Good job.
All right. Well, hopefully my mic is working. So now we come to the point in the panel where we have a conversation. I think we have a good amount of time to enter into that. So I was going to start with a question for Megan, which it was touched on briefly yesterday by the representative from Verisk, which is that insurance. We tend to think of it as a service, something we purchase, but we don't think about the market aspect, that this is actually a market with investors, that are not necessarily, it's not all driven by, the premiums we pay, but it's actually driven by a lot of other factors and the cost benefit and things of that sort, the return on investments. So could you speak a little bit to that market aspect of insurance?
They are businesses. They are here to make money. Now, they do support community resilience, and you do see that communities that have higher take-ups of insurance, they react better when they're impacted by specific events. But of course, insurance companies are also here to make money. They have to respond to their shareholders and their investors, as Alex noted. And so, with that, they need to be able to provide or charge risk adjusted rates in terms of premium. So actuarially sound rates so that they can actually make money. And in some cases for admitted carriers in certain states, the ability to charge an appropriate amount for the risk that they're taking on is being limited by the regulatory environment. So, perhaps they are only able to leverage their historical losses, and even if we're seeing trends and upticks in losses, they can't take that into account in terms of increasing their rates. And so that's where you're starting to see in certain states the insurance industry retract, and that's because they're saying, hey, we don't know how to make money here because we know the risk now, we're learning more, we have more data, we have more analytics, we have more tools, but we can't make money if you don't let us charge what we need to charge in this case. And so that's their way of saying, to the state governments, we can't write here anymore. And so there needs to be a better understanding and sharing of information, a better education of our regulators to understand that these are private insurers. It really is beneficial to a consumer to have more insurance carrier options in their state. It promotes competition and can really start to drive the market better. But they need to be able to charge and understand risk in the way that they do.
So I wanted to talk a little bit about CAT models because those are really important in fixing rates and in the profitability equation. So I wanted to ask Charlie about that before we kind of go from there to talk about the ways that some states have actually limited the ability of CAT modelers to incorporate climate risk in their modeling. So Charlie, could you speak a little bit about both the importance of spatial information and geography in CAT modeling and what it actually is and how it's used by the insurance industry?
Well, I think David did a great job last session of talking about exposure data and how it's used. But I would argue that it's a lot easier to figure out what's going to happen to a building in a CAT model than it is to happen to, the black community in Los Angeles after an earthquake, right? The people in the buildings, the systems are very, very complex problems. And I see that, CAT modeling is really key to understanding the physical impacts, but what we as a community have failed to do, and what I'd implore all of you to try to get research grants to take a closer look at, is the problems that aren't easy to address with GIS, right? There's some things that are a lot more complicated, like the behavior of people, the behavior of systems, how economies react, the tax base, all of these other cascading impacts that need to be kind of layered into the CAT modeling equation. That's some of the things that we've been trying to do at ImageCat, and we hope that to bring to the wider community.
So a bit that example of what happens to the tissue of a community if the building stands but nothing around it remains, that kind of thing.
Right. Yeah. Not only that, but when you're looking at the benefit cost analysis type of equation and only concentrating on the physical assets, you forget about who lives in the buildings and the issues that they will face, and the fact that Bill Gates doesn't probably need much help.
Yeah, well, we'll come back to this. I'm interested in that. But Megan, so you alluded to the fact that some states, insurers are pulling out of some states, and it may not only be for this reason, but there's a sense in which the state policies are actually restricting the ability of insurers to actually make profits. And so could you speak a little bit more to that?
Sure, I'll use the state of California as an example. And for rate setting for wildfire, until recently, things are evolving, as I said, you are not allowed to use any sort of prospective looking tools to develop your rates. So things like catastrophe models were not allowed to be used. You were only able to set your rates using 20 years of your own company's historical data. And so if the last 3 years have been really high, but the previous 17 years were low, that is limiting your ability to increase your rates. In addition, if you increase your rates by above a certain threshold, that really triggers a whole mess of additional layers of going through the regulation. So I think it's 6.9%. If you tried to increase anything by above that, it really triggered some additional work on your end to get that covered. And so for that reason, the insurance companies kind of raised their flags and said, hey, this is not working for us anymore. We need to be able to have a future-focused view of risk in our rate making. We need to have, be able to use new tools. We need to be able to weight more heavily our recent experience and our understanding of how exposure is shifting if you want us to remain in this state. And they did make some recent changes to adjust some of the rules around use of tools like catastrophe models or other sort of new companies that are entering from the insurtech space. But that was one step of probably 10 that need to be made in order to make that a more attractive place to write business.
Great.
If I can dovetail on that
Please,
real
yeah.
quick, there is one simple thing with regard to the Safer from Wildfires Act. So the requirement for, and obviously there's some judicious reasons around why new data sets, they're making those decisions and it's evolving, why that can't be used. But just the ability to assess the defensible space around a property is one big driver that why a lot of the P&C insurers are moving out of the state, or considering that they're not profitable because they have to report on why they're making rate adjustments. They have to say what the defensible space is at a property, and they don't have the ability to do that oftentimes. It's easy in the sense of if you have a geospatial system, you can look at imagery, you can look at data sets, you can overlay those things, or you can go back to the old world where you show up as an underwriter and go through an underwriting checklist. Those are the things that the Safer from Wildfires Act is trying to put in place in California, so you can tell the difference when you're making a rate adjustment on somebody that's deep in the wildland-urban interface, where the urban sprawl is moving folks, where the risk is higher, and differentiate between the people in the urban environment who are not near a wildfire interface. They don't have that exposure, right? So geographic information systems can help them answer the question with regard to the requirement in that act specifically, but there's a heck of a lot more going on too.
Sure. Jay, you mentioned or alluded to the fact that insurance could actually prompt different stakeholders to play a better role or a more active role in adaptation or what you would call, structural mitigation. So can you speak a little bit more to that and the ways that you could have state insurers and others working together to actually move the needle in terms of building the resilience we need?
Yeah, you got it. I mean, insurance is the backbone of resilience in our country and globally, right? And it's expanding. Insurance is growing around the globe, but the connective tissue between the government and the ability to understand the roll of the dice and the potential outcome, and the collaboration between private organizations who are relying on the profitability, right? The ability to count cards, so to speak, right? It's the game of risk, right? We're pricing risk, and the ability to do that more precisely and share those insights with organizations is critical. One example, like in Florida, and in many states, we have state-backed insurance organizations that are kind of an insurer of last resort. But in working with those companies that are state-backed insurance organizations, right, we can set standards that not only allow more of that to be in the market and the free market for insurance, and not a burden on the taxpayer, but we can also put in place what we talked about, that mitigation step. loss control, right? I think those things are all a collaboration between the departments of insurance in each state in the U.S., right? We've got the regulators that we've got to be concerned with, those state-backed insurance organizations, and the insurer, and collaboration across the plane there will lead to, you know, better decision-making, better mitigation, better loss control, which is resilience.
Great. In our lead-up to this, you know, panel, we talked a bit about some of the new technologies and approaches like parametric insurance, that, you know, if you reduce the cost of having an adjuster go out and actually survey the damage and just say, well, you know, from satellite imagery, evaluate that the house was burned down or a substantial portion of it was damaged. Or, you know, I guess there's this term, InsurTech. I liken it to the little device I put in my car that tells me, you know, if I'm driving too fast and braking too hard, and I hate it when it beeps every time I brake too hard, you know, because I know my insurance rate's just going to go up. But try doing that in New York. It's really not easy. But anyway, tell me a little bit more about what some of these technologies are, or novel approaches that might actually help solve the liquidity issue in insurance markets.
Yeah, sure. I mean, I can tell you right off the bat, the concept is easy when it comes to a wildfire. You know, when you look at the profitability of insurance, one category in there is LAE, loss adjusting expenses, billions of dollars industry. That's where I started my career. And I can tell you, it's you know, there's a good business in there. Going out, looking at the damage, documenting it, sharpening your pencil, drawing things, using cameras, estimating them, you know, reviewing them, and then indemnifying them and making the payment. But in a wildfire, do you really need to do all that? My house just burned to the ground. The last thing I want is an adjuster to show up. I need to move on with my life. I need funds. And at the end of the day, if we can create a parameter for an insurance product, we can quickly streamline that whole process and reduce the loss adjusting expense. So parametric insurance products could apply to things like wildfire. I think we will see things like that in the very near future. One of the things that we do see in the world is drought insurance. Synthetic aperture radar from satellites from some of our partners, they look down at the earth through clouds or smoke day or night, and they're able to sense the soil moisture and measure a parameter. And when insurance products are inaccessible in, you know, agricultural lands in Africa, they can still look and measure the ability for soil to bear fruit, to grow crop. And when it reaches a certain parameter, right, it's a drought, and they can pay out that product without incurring loss adjusting expense, right? And I think there's a number of different areas where that can apply. If a flood reaches a certain height, sensors could be in place and create new products that would allow for a quick flood settlement. Because flood, if anybody's ever been involved in a flood claim, it is a mess for a lot of reasons, right? There's a lot that goes into that. But a parametric could be in place, and people are developing them for things like flood and other perils.
Great. Yeah, we have an expert in the room, Dan Osgood, who's doing that, just that in many low-income countries through the Serve Your program. We can take one or two questions from the audience if there's anyone who wants to get up and go to one of the mics. While we're waiting, I'll just ask one other question. So, Charlie, you talked a bit about this issue of equity and the people who live in the buildings. I guess my question is there any way for insurance markets to tell whether, you know, we often blame the victim in a way, like you live in a flood zone. You shouldn't be building in a flood zone. But there are a lot of people who, you know, because of redlining, historic issues, they haven't been able to choose where they build, and we have to distinguish some way between them and the ones who built like multi-million-dollar properties right on the beachfront because they have that kind of money. So I'm wondering, you know, maybe we can come back to this. I do want to hear from the audience, but if you have a word or two in a moment. We're going to hear one more question here, and then sorry to hold you off, but yes, go ahead. Please introduce yourself.
Hi, good morning. My name is Frank Ortega. I'm an economics professor at CUNY. This was a great panel, and my question is about the interaction between private insurance companies and public insurance programs, in particular on flood insurance. And I wanted to hear if you have any thoughts about how the recent change of the pricing system, this risk rating 2.0, what are the effects that that's having on insurance flood insurance uptake, and how is that gonna impact private insurance, homeowners' private insurance?
Okay, we're going to take one more over here. Thank you very much. And then we're going to try to bundle these last with your closing remarks. Okay, so yes.
Hi. Mark Raker, I'm representing Geospatial World. Just curious, we've had discussions about social inequities and how that's dealt with in the insurance environment. I think you mentioned that CAT models don't do a good job at addressing that. Do you see a future where there's a blending of both government and insurance cooperation to deal with the social inequities? And for instance, looking where properties are in very high-risk areas, and the infrastructure bill, for instance, is helping, along with insurance investment, to help relocate families from areas that are destined to be damaged in an event. Yeah. Right now, it's sort of one or the other. But there should be some scales of economy if we can find a way between government and the insurance sector, numbers 1 and 2, dealing with risk, to be able to address those types of things and be able to get at the equity issue as well. So I want to just pose that question to you all.
Yeah.
So if any of you wants to take up one of those 3 questions that were posed at the end, but try not to answer all 3, okay? So let's start with Megan, and then Jay and Charlie.
Okay, I'm going to start with that last question because I find that a really interesting space where I've seen the conversation change quite a bit recently. And the answer is yes. I think there is the need for collaboration between government, between the insurance industry, and academia. And those 3 coming together can really work together to create the right solutions. And I'm seeing that happen. So we work really closely with some of the government-sponsored enterprises that hold some of the mortgage risk. And they're basically saying, hey, we're concerned about flood because there's a protection gap and there's a risk of mass defaults. And so we want to hear from the insurance industry what they perceive the biggest challenges are so we can do a better job to educate ourselves so we can do a better job of educating our mortgage holders on their risk and see if we can really move that needle in terms of creating new products that are affordable and that will also improve their risk. And in order to do that, we need InsurTech to be able to help us to better understand risk at a highly granular location level. We need the GSEs to really be asking that question and be willing to be out front in terms of talking to communities and doing that education. And we need the insurance companies to be open about their pain points in terms of opening up that private market and creating more opportunities to absorb that risk.
Jay, over to you.
Yeah, I'm going to take the NFIP one. For a little perspective, I was an NFIP certified adjuster, right? So I understand that whole process. I can tell you right now, NFIP is broken. There's a lot of bad risk out there. There's a lot of properties that are going to experience a lot of loss. There's a lot of capital in real estate that is going to flood, and it's bad risk. There is not a sustainable business. There's not an easy answer for that. Now, the risks that aren't in those areas, I think companies like Floodbase and other insured techs that are doing the analysis to provide the information, like the Safer from Wildfires thing I talked about, to provide the information that it is not at risk, or the mitigation steps to put a levee around a factory, what have you, to make it a good risk. That's going to be the crux in ensuring that there is a profitable business around the peril of flood in the future. So hopefully that answered the question over there.
Great. Charlie.
Yeah, I think they're all 3 pretty similar. I really agree with Megan's response. I would love to see a government-sponsored, need-based, parametric-triggered insurance program to increase the capacity to help people respond to events and tie that to mitigation efforts so that people start to build the right way. Excuse me, the challenge will be to do that in a way that doesn't incentivize bad behavior in terms of risky development.
Great. Well, thank you so much to our panelists and